If you want to get rich by investing in stocks, this is exactly what to look for in a stock before investing. If you mess this up, you're going to spin your wheels and struggle for a long time until you finally figure it out. But if you get this right, you can pretty much just sit there and get richer and richer year after year. First though, please give this video a thumbs up, that really does help out, and let's get into it. So naturally, the higher your annual investment returns are, the faster you'll get rich, and the sooner you'll reach the status of being independently wealthy. Earning 6% annual returns, an investment of $10,000 after 40 years turns into $102,000. Earning 12% annual returns, an investment of $10,000 after 40 years turns into $930,000. And earning 18% annual returns, an investment of $10,000 after 40 years turns into $7.5 million. So obviously we'd all prefer the 18% annual returns, but how do you get super high returns like this consistently? Well, the price you pay does of course matter. However, there's another factor that's almost equally as important, which is the quality of the business. Listen to this quote here by Charlie Munger. Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for 40 years, you're not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with a fine result. So the term return on capital is actually funny because it's calculated slightly differently depending on who you ask. However, for the purposes of this lesson, we don't need to get caught up in those details right now. Return on equity capital, or simply return on equity, is similar to, if not exactly what he's referring to in this quote. And here's how return on equity is calculated. Return on equity is equal to the company's net profits divided by the shareholders' equity. And shareholders' equity is equal to the company's total assets minus their total liabilities. Calculating shareholders' equity is actually very similar to how you'd calculate your own personal net worth. Calculating your personal net worth would mean adding up all of your assets and subtracting all your debts and liabilities, and what's remaining is your personal net worth. So shareholders' equity is basically another way of saying the net worth of the company. And the return on equity calculation, what it does is it gives us an idea of how much money the company makes in relation to how much capital is required to make that money. Let's say a company has $100 million in equity. If that company earns $18 million of profit in a year, that would equal an 18% return on equity. 18 million divided by 100 million equals 18%. Now here's the thing, if that company does not distribute that profit to its shareholders as a dividend, and instead it puts that money in the bank to earn, let's say 2% per year, that would mean two things for the following year. First, the company's shareholders' equity would increase by $18 million and now be $118 million of shareholders' equity. Second, now in the following year, if our company earns $18 million again, total net income would be $18 million plus the $360,000 of interest income that it earned on the previous year's $18 million that's been sitting in the bank, for a total of $18,360,000 earned in the second year. So return on equity in the second year would therefore be $18,360,000 of total net income divided by shareholders' equity of $118 million equals a 15.5% return on equity. If the company were to continue like this, just putting their profits into the bank to earn 2%, then by the fifth year of this, the company's return on equity will be down to 11.2%. And that comes from the operating business earning 18% and the cash earning 2%, blended together gets you that 11.2%. So therefore, it's not enough for a business to earn 18% on equity capital alone, but it also has to use the money that it earns effectively so that it can continue to earn that 18% year after year. Okay, now listen to what Warren Buffett had to say about this during the 2003 Berkshire Hathaway annual shareholder meeting. This is so key.
The ideal business is one that earns very high returns on capital and can keep using lots of capital at those high returns. I mean, that becomes a compounding machine. So if you have your choice, you could put $100 million into a business that earns 20% on that capital, say 20 million. Ideally, it would be able to earn 20% on 120 million the following year and 144 million the following year, and so on. That you could keep redeploying capital at these same returns over time. But there are very, very, very few businesses like that. The really, unfortunately, the good businesses, take a Coca-Cola or See's Candy, they don't require much capital. And incremental capital doesn't produce anything like the returns that this fundamental return that's produced by some great intangible. So we would love the business that could keep deploying. In fact, even well beyond the earnings. I mean, we'd love to have a business that could earn 20% on 100 million now. And if we put $1 billion more in it, it would earn 20% more on that billion. But like I say, those businesses are so rare. There are a lot of promises of those businesses, but we've practically never seen one. There've been a few. Most of the great businesses generate lots of money. They do not generate lots of opportunities to earn high returns on incremental capital. We can deploy X at C's and earn a lot of money. But if we put 5X in, we don't earn any more money to speak of. We can earn high returns on X at the Buffalo News, but if we try to make it 5X, we don't earn any more money. They just don't have the opportunities to use incremental capital. We look for them, but they don't. But what you've seen is that we've bought businesses largely that earn good returns on capital, but in many cases have limited opportunities to earn anything like the returns they earn on their basic business with incremental capital. Now, the one good thing about our structure at Berkshire is that we can take those businesses that earn good returns in their business but don't have the opportunity for returns of a similar magnitude on incremental money, and we can move that money around to buy more businesses.
So as you've just heard, the type of business that can earn high returns on capital and then continue to earn high returns on the incremental capital that it generates year after year is very rare. Walmart, over the past 60 years, is probably a good example of a company that was able to do it. Walmart was able to continually redeploy its profits towards opening new locations. And if you invested in Walmart back in the 1970s, you would have 100x'd your money after only 12 and a half years. That would mean turning an investment of $10,000 into $1 million. Not bad for simply identifying a great company and then just sitting on your hands. Getting into these types of companies when they're small is a great way to do it. It's not easy. However, trying to identify these types of companies early could be a very worthwhile activity to devote yourself to. Now I'm going to circle back to this point in just a second because obviously that's the big question we're all asking right now. How do we get into these types of great companies? And I'll get to that. However, as you've just heard Warren Buffett say, a business like this, one that's able to redeploy its capital back into its existing operations and continue to earn equally high rates of return is very rare to find. Most great businesses will earn high returns on capital, but they won't be able to redeploy it at equally high rates of return, which is still great. And this fact actually further reinforces why consistently high returns on capital is so important to look for in a stock before investing. Because when you see this, it means that either the company is able to redeploy its capital back into its existing operations and continue to earn high rates of return on it, or if not that, then it means that the company's management is at least good at distributing back to its shareholders, either through dividends or through share buybacks, any of the cash above and beyond what it's able to deploy in ways where a sufficient rate of return can be achieved. For some of the businesses out there, it would be almost impossible for them to achieve high returns on capital, either because it's a business that's super capital intensive, meaning a company that requires a lot of expensive machinery, for example, which needs to be constantly replaced and upgraded in order to keep up with competition, or even just because it's a company that is in such a competitive industry that profit margins are so tight regardless. And these are the types of businesses that Warren and Charlie hate, no matter how great the management is and no matter how cheap of a price they're able to buy it for. Buying subpar businesses like this means you're going to be needing to do a lot more buying and selling. In other words, you'd be trying to buy the company when it's priced under its fair value, and then you're going to be needing to sell it once it finally reaches its fair value. On the other hand, buying great businesses that earn high returns on capital consistently year after year, well, these are the types of businesses that you can buy at even just a fair price and then never have to sell. I mean, at least until it's grown enough that it's enough for you to live off of, and then you can sell, or you can just live off the dividends. Warren Buffett often talks about his preference for buying and owning businesses that have what he calls an economic moat, which he also refers to as a company having a durable competitive advantage. These types of companies have what's called pricing power. Now, there are 8 sources of pricing power that a company can have. And when a company has one or more of these sources of pricing power, this is where their economic moat, aka their durable competitive advantage, comes from. This video right here covers these 8 sources of pricing power in some nice detail. And I'll also soon be making a dedicated video on this subject. So be sure to subscribe so you don't miss that one when it comes out. And by the way, knowing this is going to be especially important if you're going to be looking for those smaller up and coming companies like an early stage Walmart. Besides buying these great companies when they're small, the other way to get into these types of great companies is to buy already established great companies, but to do so when they're priced attractively. Remember, Charlie Munger said when it comes to buying great businesses, even if you pay an expensive looking price, you'll end up with a fine result. If you've watched other videos of mine, you already know that stock prices often don't reflect a stock's true value. In the long term, prices do gravitate towards their true value. However, in the short term, prices are based on emotions and liquidity. So ultimately, Ultimately, what ends up happening is that stock prices will fluctuate above and below their true value. It's this inefficiency that value investors like Warren Buffett and Charlie Munger have been exploiting ever since they were young. And it's what's made them so rich. And if you're keen on learning investing, it's what's gonna make you and I rich as well. So here's some cool free tools that you can use to help you along the way. There are various stock screeners available online that allow you to filter stocks by various criteria, return on capital being one of them. Most of the stock screeners are a paid service. However, there's a free one at magicformulainvesting.com, which does exactly what we've been talking about here in this video. This particular stock screener does not allow you to pick and choose your own criteria in the way that some of the more comprehensive screeners do. However, what it does do is it ranks stocks by a combination of both return on capital as well as cheapness. And the cheapness factor, by the way, is based on how much profit the company currently makes compared to the price you'd have to pay to buy it. If you want to learn more about this cheapness factor that I'm talking about, you can do so by watching this video here on the price to earnings ratio. And then another good free tool to check out is quickfs.net. And this website allows you to see many of the most important financial metrics and historical financial data of a company in a nice at-a-glance view. Here we're looking at Facebook stock, which by the way, I think is currently priced pretty nicely and is a company that I'd consider to be one of these high return on capital type companies that we've been talking about here in this video. And this row right here shows how their return on equity has looked over time, which is exactly what we've been talking about in this video as well. On that note, if you can think of anyone that would enjoy these types of videos, please go ahead and share it. That would be awesome. Quick reminder, I'm not a financial advisor, so please don't take my content as financial advice. I'm just someone who loves investing and has spent a lot of time learning about it and a lot of time thinking about it. And besides, a future great investor like yourself always does their own critical thinking anyways. Click or tap this video right here to keep growing and to keep learning, and I'll see you in the next one.